Hello friends, I'm Vijay Bhambwani. I've been trading these markets since 1986, and through my videos and social media, I try and help fellow traders interact and exchange ideas to basically improve each other's trading experience in the markets. Now, in this video, I want to talk about what I made out of the budget. Of course, the budget has left the new Income Tax Act to be announced a week from now approximately. So to that extent, it's half of the information out. And on the 7th of February, the RBI's Monetary Policy Committee is meeting to determine interest rates. So what I made out of the budget, frankly, was not much was expected from the budget because of the reasons that I have stated in this video, that the rupee has now fallen past the 86 levels versus the US dollar. That leaves little elbow room for the government. Liquidity is tight. I've been posting on my Telegram channel. Please do connect with me on my social media accounts, wherein I put up a lot of data, a lot of news and views, and exchange a lot of ideas with my online family. So, the fact that there was not much by way of reforms or by way of announcement on LTCG, STCG, etc., was not really a surprise. But the two things that really caught my attention and I want to discuss with you in this video is the fact that the Honorable Finance Minister announced two measures. Number one, an increase in the credit to farmers, always welcome. The Kisan credit limit, which is 3 lakh rupees per farmer, is now being endeavored to push past at least the 5 lakh rupee mark, and higher lending, easier lending to medium and small enterprises, MSMEs, which of course are responsible for approximately 40 to 45% of the nation's exports, and 1 crore of these MSMEs are responsible for generating employment to 7.5 crore people, as per the Honorable Finance Minister's speech. Now, the fact that you want to lend more money to them is a good thing, but there is a slight concern here. I give guest lectures at the Indian Institute of Banking and Finance, and I've also taught banking when I used to be a visiting guest lecturer at the BSc Training Institute and the NSE Academy. So I've studied the principles and practices of banking and the Banking Regulation Act. I can tell you that farming and MSMEs fall under what is known as PSA or PSL, Priority Sector Advances or Priority Sector Lending. Now, this is how it works. Of the entire loan book of any bank, at least 40%, if not higher, has to be money lent to priority sector lending or advances. In that come MSMEs, in that come farmers, export-oriented units, import substitute products, anything that helps the nation achieve and reach a better or a higher place than where it is now is a priority sector. Now, 40% of the loan book has to be constituting priority sector advances or priority sector lending. But what if you do not reach 40%? Does it mean you have to shut the bank down? Hey, no, not at all. As a matter of fact, many private banks who do not have such a large footprint in the rural areas, and especially foreign banks, they do not have presence in the rural market to lend money to farmers. So what do? So they do not lend to farmers. They basically may not be able to lend as much to the MSMEs. What do? They then, whatever is the shortfall of that 40%, they invest that money in NABARD bonds. And on those bonds, they receive a haircut on the coupon rate, which means a smaller amount of interest than NABARD would have normally paid them. This is because they did not meet that 40% priority sector advance threshold. All right. So, which is what foreign banks and some private banks do. Why do they do this? Why? You need to have the cause and effect theory mindset to be able to become a good trader. The reason why they do that is because agricultural and MSMEs, as it is, struggling under fairly high degree of challenges. And I have been posting a lot of content on especially my Telegram channel. My contact coordinates come at the fag end of this video. Please connect with me there. I've been telling you how loan recoveries, etc., are getting sticky, delinquencies are rising, microfinance institutions are having delays in collections, etc. There happens to be in agricultural and the MSME sector higher delinquency rates, number one. Number two, this sector is also politically sensitive. It is expected that once ever so often, especially election time, there would be loan write-offs and a liberal renegotiation of loans, moratoriums, interest discounts, etc., etc. Which is why banks are a little iffy, are a little concerned about lending here. So now that if you're going to push them into lending money to MSMEs and agricultural segment, I am not against this. Please, let's not make this a political issue. I'm a trader. I do not discuss politics in my videos. What I am basically concerned about is how will smart money treat this move? Will it start getting nervous about banking stocks? Will banking stocks start coming down? If you see the public sector banks, PSBs, their stock prices have basically come down. It is more of public sector banks that lend to farmers than, like I said, private and foreign banks. Definitely, foreign banks don't lend to farmers. All right. Why is the banking sector so important in my viewpoint? It's not. I am a statistical systems trader. I go by the cause and effect theory, and here is my cause. As you can see, the banking and financial sector segment constitutes 34.6% weightage in the Nifty. Now, when the Nifty is made up of this segment, and this segment is higher weighted than the remaining three sectors after it put together, which is what makes the finance and banking segment a swing sector in the Nifty. Whichever way the stock prices of banking and finance go, that way the Nifty will get dragged. Maybe after a lag, maybe immediately, but it will happen. Now, if the market was to get nervous about higher lending to farm loans and to MSMEs and the banking stocks come down, can the Nifty remain far behind? That is one concern, and that's part one of what I said, the 2 points that I will watch. The second part is those of you who are connected with me long enough will understand and remember how I have an obsession with the bond market. As a matter of fact, I have led the way in analyzing and talking about bond markets ahead of equities because I have been vociferously saying that the bond markets are responsible for financing the price discovery mechanism of the other asset classes, which is equities, commodities, currencies, etc. All right, this is the money supply of the market. So cost of funds is very important. Now, the Honorable Finance Minister laid out some budgetary numbers, which is what the budget is all about. Now, she said that the government intends to raise estimated, these figures can get revised as the years go by, as the year goes by, but as we stand today from the budget speech, she said 14,82,000 crores will be the gross borrowing in the financial year 2025-2026. Figure is quite large. All right. Now, how will this money come? Out of this 14,82,000 crores, 11,52,000 crores will come from dated government securities, which means bonds, T-bills, etc., etc. Okay. Now, on this, of course, you'll have to pay interest. Now, that is where cost of money comes in. I have been begging, imploring, pushing, nudging, forcing my online family to please study Dick Stoken's books. I have given you hyperlinks. There is one more in the description and in the pinned comment below this video where you can read his books for free online. In my humble opinion, I am old school. So this guy was at the forefront in the 1970s and 1980s in talking about cost of funds, and his brilliance I have not read elsewhere. Of course, not that I've read each and every book on bonds and cost of money, but gold standard. So please do read Dick Stoken's books. If the government is going to borrow 11,54,000 crores from the bond market, and the remaining is to come from what you call small saving schemes. Now, these small saving schemes invariably tend to be sovereign guaranteed, which means hypothetically speaking, the Honorable President of India guarantees the return on and return of investment, the capital and the interest that you place in those schemes. Of course, there is a limitation to how much money you can put in there. For example, in a PPF account, you can't put in more than 1,50,000 rupees. In a senior citizen account, you can't put in 30 lakh rupees. In a post office MIS or monthly income scheme, you can't put in 9 lakh rupees as an individual or 15 lakh rupees as a joint account. Yes, so there is limitation, but if the government is saying that 11,54,000 crore will come from bonds and the remaining will come from small saving schemes, what if the stock market turns a little more nervous and people pull money out of stocks and start putting more money in small saving schemes? And remember, the government is, as it is borrowing more from the bond market, the coming meeting on 7th of February of the Monetary Policy Committee of the Reserve Bank of India, will they be in a position to reduce interest rates when we know that they are going to borrow 11.5 lakh crores from the bond market in FY 2025-26? Hey, to me, it looked like the cost of fund is going up, if at all they don't cut rates. And if they cut rates, the check writer is not writing a check. That I have already showed you in my write-ups in my Telegram account. And of course, my WhatsApp channel and YouTube channel, etc., etc. So, if the government is going to borrow, and if the RBI Monetary Policy Committee is not able to reduce interest rates, and if the interest outgo of the government is going to go up, and if the stock market comes down a bit and more people put money in the small saving schemes, the interest burden goes up higher. That will weaken the rupee versus the dollar. Now, a weak rupee means that everything that we import becomes expensive. I'm not bothered about your cell phones and your smart watches and your imported shoes and jeans and all. That is not mission critical. What is mission critical is crude oil. What is mission critical? Imported medicines. Now, these will drive up inflation. This is called imported inflation because it is triggered by your currency weakening, and therefore whatever you import becomes more expensive from a treasury point of view. These are two concerns that are top of the mind in my head. As a real world trader who cares about cost of funds, and please study Dick Stoken. It's not too late yet. This knowledge will make you far ahead of guys who don't know the cost of funds theory. As a guy with a real world vested interest in the market, because I trade for a living, these are two issues that come to my mind immediately after I've read and analyzed the budget. Will there be more? Possibly, yes. When the Honorable Finance Minister lets us know about the new IT Act, which is underway, it will be announced approximately in a week's time. Maybe if I find something interesting, worth enough to share with my online family, of course I will share it with you. But for now, these are two things that are basically top of the mind recall. Now, what do I do about them? First things first, today, as I watched the budget on Saturday, the bond market was shut. So we don't know what the bond market is going to do. I'm going to watch sovereign 10-year benchmark bond yields and other dated securities with a hawk eye. I want to see what the bond market is thinking about interest rates, about the debt burden of the government, and about which way the rupee is going. I will take a fresh view after that. In the interim, if I find anything, I will share it with you on my social media accounts, on Twitter, on Facebook, on LinkedIn, on my Telegram and WhatsApp channels, YouTube community posts, etc., etc. Please make it a point to connect with me. My contact coordinates come at the fag end of this video and in the pinned comment and description below this video. Friends, a request here. My channel is lifetime free. It always will remain that way. And there is a lot of labor of love going into making these videos. I would Very greatly appreciated if you can encourage my work by sharing it with your friends, your family, your social media groups on WhatsApp, Telegram, or whatever platform that you are on, and help me spread the cult of knowledge-based investments and trading. Before I sign off from this video, a reminder to subscribe to my YouTube channel if you haven't already done so. Click on the bell icon to receive instant alerts about fresh videos being put up out here. In the comments segment, do let me know what you think about my work and how I can make it even more relevant to help you achieve better trading success. I thank you for your patience in being with me in this video. Till we meet again in my next. This is Vijay Bhambwani signing off for now. I wish you have a very, very profitable day ahead. Take care. Bye-bye.